right, in studio I have Leo. Leo, welcome. I appreciate you coming down here. We're starting we've started a segment about different areas of people's lives that they need to consider health, right? And so you have physical health, you have financial health, spiritual health, and whatever. So you're my expert that I'm bringing here to talk about some financial health. I'm sure you see people in all different phases of life. So where do you think we are the fattest or the most unhealthy from a financial perspective?
That's an interesting question. First of all, thanks for having me on the show. Physical health and financial longevity all tie into what we do as a financial planning firm. So when we look at that in people's health, especially when they're in their later 50s, early 60s, there's statistics out there, for instance, that says the average person, once they hit retirement, will spend on average $270,000 in retirement on health care. But that's not necessarily everybody, but that scares everybody. So from a financial planning firm, we've dug deeper into what that number means. And we have found people that are 55 to 65 that are entering that phase of their life unhealthy are the ones that spend considerable money on retirement, which can blow a hole into their financial plan. Mm-hmm. And those are the ones that typically don't hit their lifetime goals of where they want to live to. We find that those that are 65 or 66 now, with 66 and 10 months being the full retirement age of Social Security these days, we're still in a world used to talking about 65, but it's moved to 66 and 10 months. We're finding that those people that are 65 and healthy spend considerably less in retirement on health care, which means their financial plans work way better. There's much more success, and we're finding, trending on, that their legacy planning is more significant than they anticipated. Because we're finding in those folks, and I could tell you story after story of an 88-year-old client of ours that's still very active, independently living, even much to the chagrins of their children that they're still driving,
right?
But they're not giving that up because that's one of the last things they always give up. Yeah. So that's where we see financial planning, healthcare, where people are integrating and what the risks are when they get to those different ages.
And so, if you have a 20-year-old kid that starts contemplating where their financial, trajectory is going to go versus someone who waits till they're, in their 50s to say, hey, I should probably start figuring something out right about now. Got a lot more options when you start out earlier, I'd assume.
So we've been around long enough, 38 years in the wealth management business. So I say that we don't really follow national statistics anymore, Joe, because we have enough of our own. We've seen enough people through the accumulation phase of their life, the process, we call it disengaging from your current profession. We don't like the word retirement anymore because with retirement, there's a sense of finality to it. And people retiring today are so much healthier that the next 10 years in retirement means something significantly different than even 10 years ago. But what we have found, to your point of optimal savings times, one of our areas of expertise at our firm is 401k plan and design, okay? And I will tell you that 15 years ago, when we were implementing 401k plans, if we had an employee penetration rate of 40 to 42%, we were thrilled. And I can tell you almost none of those people were under 35. Because when you're younger, it's Friday night, you don't know your own mortality. Retirement's 4.5 billion years away. Right. So no matter what logic you threw at these people, they didn't want to hear it. I'll tell you today, there's a generation that saw their parents financially blow up because of the housing crisis in 2008 and 2009, saw their parents living longer. Our employee penetration rate on a new 401k is in the high 80s. I don't have to convince the young person to save anymore. The other big key, and this is, again, our own data, the young generation that we pull when we ask them their interest in saving, just out of curiosity, what flipped? None of them believe they're going to get Social Security. They all believe they're going to be on their own. And they saw their parents going through things, and now the parents are saying, don't make the mistake I made and wait till my 50s to start saving, because look at me. I'm 65 and I still have to work because I didn't start early enough. So go back to trends, okay? Where did that come from? Why did the parents' generation today feel like they're sandbagged a little bit, okay? So go to the generation ahead of them, okay, their parents. That was the pension generation. So the pension generation didn't feel the need to save that same way because they relied on their employers, okay? Right. So they spent more of their money. So their kids, when they started out, and I'll tell you this, in the last 15 years, most pensions have been frozen, but so many people started their working career 40 years ago with a company with a pension. So they didn't save in those early years. That's why they're trying so hard to play catch up in their 50s. Because what they were relying on then, which the information they got from their parents, and that's what companies were doing at the time, okay, said, okay, go ahead and spend the extra money. You don't need to save for retirement because I got all this other stuff from the company. So that's why the generation today is telling their kids, save now, and the kids are listening to it.
So over the years, you're my favorite person to talk to when it comes to long landscape look at the economy in general and consumer spending and whatnot. And you've always kind of talked me down from the ledge because the media will play it up like this is the second Great Depression on the horizon, and you should be scared about spending a dollar. And you're like, I looked at the data, and consumer spending is still really good. The recession numbers still really good. You should not, light it on fire just yet.
Right.
So how are you keeping such a level head in sort of contrast with everyone else?
Data. We live in a world, and like you, we know plenty of folks in the media business, and the biggest challenge they face, and you know this, but what they face is there's so much capacity for news, and there simply isn't enough news. Okay, so many times news gets sensationalized just to try to keep your attention. I get it. People are trying to do what they got to do. My job and what I do is to say what's real and what's not real,
right,
and what's sensationalized and what's not. And the thing about data, and you're a big data guy too, and you get this, the challenge with data is always how that data gets interpreted.
Right.
Was it interpreted with bias or without bias?
Yeah, right.
Okay? That's a big challenge. So I'll look at it and say, what is the interpretation of the data? Then I'll play in my own mind both sides of it to see where the data really goes, okay? Because even if it's data that's still subject to somebody's interpretation, I don't do that. So I read multiple sources. I'll look, when I see a report about something with the economy, I never take it at face value. I keep digging and digging. It was a report out about 6 months ago when credit card debt, which is now coming back to everybody's conversation, where the consumer debt was getting to $1 trillion, and it was an oh my God story, right? Mm-hmm. But if you dug deeper into it, 4 years ago, we were almost there. If you factor in inflation, we are actually less in debt than we were as consumers 4 years ago. If you looked at the default rate now versus 4 years ago, pre-pandemic, when everything was supposed to be rocking and rolling, right? The default rate is lower now. Okay? So when you dug deeper into that report, when it started out with the, oh my God, look at the debt, to really digging into it, and you factored in inflation with everything else, we were okay. Now that story's changing today because with the rise in interest rates, do you know what the average interest rate is on credit card debt today?
I'm going to say at least 20.
24.99.
Man.
Yeah. My joke, but there's a lot of truth to it. Even the mafia had more compassion than that.
Oh, if you were carrying a balance on a credit card, that is killing you.
Right. So now, and interest rates then, think about it. That's almost 500 basis point increase, or 5%. Credit cards used to average 17.99, which was still awful. But so much less money is going to be going towards paying down that actual principal, that the longer term risk of that is going to be people are going to be in debt a lot longer. So I think there's some short term pain left to go in the economy. That the Federal Reserve, and I get this a lot from clients, interest rates are awful. I'm old enough to remember my first mortgage being 9+% at the time. We found a way to afford the house. Kids today will find that way to afford the house, or prices will come down to where they hit their equilibrium. Mm-hmm. That's just how economies work. It's just basic supply and demand, and I don't overthink that. A lot of people now have chosen to stay in their houses because the average mortgage rate is sub 3% for those in a house. So those that may have thought about moving and trading up or out aren't, because it's a 7% mortgage for them now. So that's why the refinancing market is kind of dried up. But that's why the home improvement business is doing great.
That's right.
Because they're staying. So it's a sector scenario. So I'm always looking at these moving parts. So if you look at the economy and you want to look at what used houses really do for the economy, not much. They really don't. It's new construction, which is the economic driver, right? But let's go back to interest rates, where this whole thing started. Where are we and how bad is it? My opinion is the interest rates that we have, if you think of what's going on with the economy right now, we can take it. They're here because the economy can take it. If the economy couldn't take it, they would be saying, bad decision, let's back down, right? And they're not doing that. They're saying higher longer, which means the economy's still running hot. Okay, that's the real
In spite of it, people are still buying with intensity.
Right. But what this has done down the road, and let's keep that runway going longer like we talked about, that when we hit a soft patch in the economy, which we will, we always do, nothing stays good forever, nothing stays bad forever, right?
Right.
Okay? So we now have finally given the Fed some tools back. We went from quantitative easing, which was printing free money, flooding the market with cash. There wasn't much to do with it. Bonds weren't paying anything, so people bought stocks because there was nothing else left to buy. And if you look at all the mergers and acquisitions that happened, the amount of stocks companies to buy, it was actually pretty low. So what was there that was good just kind of blew up. Well, now you have bonds back in the game, right? You can get a 5% bond, and a lot of people are saying, hey, that's good. I'll take 5% on my money. So stocks aren't the only game in town. So now bonds are competing for investor money. So it's a basic supply and demand issue right now. And I think what we're going to see, and I think we're going to have a pretty volatile time from here through the first 6 months of 24 for two reasons. Number one, I think the full interest rate effect is just hitting companies. The cost of refinancing debt, because so many of the growth companies for the last 10 years did it on debt. Well, when your debt's 2%, you can play that game all day long. Well, when your debt now goes to 6%, it might completely wipe out your earnings, right?
Right.
Same business model, same profitability, just the cost of your money. So people think, oh my God, they're going to go out of business. And I sit there and go, well, no, maybe this is time for that company to do another stock issuance to pay down the debt. Right. So there's lots of solutions out there other than this doom and gloom. That's going to be the only outcome solution.
So that pain, do you have a prediction as to where it's going to be? Is it going to be more in, interest rate on bonds? Is it going to be in consumer interest? Is it going to be in commercial real estate? Like, where do you think the next bubble pop or a big amount of pain is going to come from?
I think commercial real estate is under extreme pressure, and they have been since the pandemic. And I think that was a pre-interest rate pressure, because and I'm reading about this all the time, especially the large cities. Their occupancy rate is still 50% pre-pandemic. And companies, as much as companies want their employees to come back to the office, some are flat out, believe it or not, flat out refusing to come back. But hiring is slowing down. People are starting to keep their jobs now, and it's not because they're becoming afraid. People are actually content. That's the underlying sentiment of why people aren't job shopping anymore. But so as a result, if they're content with a hybrid scenario, then that office scenario, think about it. It's not just the interest cost. Let's talk about insurance for a minute. Pick it. Pick your auto insurance, pick your home insurance, pick your commercial insurance. It's crazy expensive these days, and it's been going up a bunch. So you add interest costs to the commercial borrower. You add their increase in insurance cost. You add the decrease in occupancy rate, which puts pressure on you to try to increase your rents, right, to compensate for these three headwinds I just mentioned. So that's why I think it's troublesome. What I think is going to happen, Joe, is I don't see an overall recession. And you know me, and I've been saying this for over a year. I've said we're not having one, and I was the only guy out there. In fact, a buddy of mine, he's an analyst as well. We did one of my Sunday shows about a month ago, and he said, Leo, you and I have been the only ones on Optimist Island for a long time, and but we're right, and we've been right, because the fundamentals simply didn't dictate what the headlines people were trying to get across to people. It just simply wasn't there. I still don't think we're going to have a recession. I think we're going to have pocket recessions, and I think commercial real estate is going to be one of those pocket recessions, because commercial real estate to the average person doesn't affect them.
Right.
It's become such a big money game, right? That it's going to affect the big money players. Okay, so that's where you'll see recessions like that.
And I think that's healthy, because if an industry doesn't have a down, there's no entry point for new people to come into that market, and it's the same old people without innovative ideas. You know what I mean?
And this is something how you think and something how I think. and I've run my business for 30 years this way, that with every crisis, it creates an opportunity.
Absolutely.
It just depends on, I was hearing a speaker a couple of months ago, and he said to my sales team, when a thought enters your mind, it's neutral. What did you do with that thought? Did you make it a positive thought or a negative thought? Right?
Absolutely.
Okay. Your brain didn't know what to do with it. You decided what to do with it,
You
right?
created the filter.
That's right. You created the filter. So I look at things like this by saying, from an investment point of view, am I sidestepping things that are going to do that? I sure am. But is it a demise or is it a reset? I mean, think about it. For 15 years, commercial real estate couldn't miss. They couldn't build enough. They couldn't charge enough. They couldn't stuff them enough, right? Like take New York City, for instance. That I think that's a bigger city, and everybody's, and I think San Francisco has a PR problem, big PR problem, because it's crime and homelessness. Nobody wants to go there anymore. Nobody wants to live there anymore. They have to fix that before they fix their business problems. But think about it, if you're a New Yorker, it's been crazy growth, right, in their commercial real estate.
Yep.
And now if you're, and I read a report in the Wall Street Journal a couple of weeks ago about this. It said during the week, their occupancy in the office buildings is about 50% midweek, but on Monday and Friday, it's like 25%. Take all the restaurants that rely on those workers, right? All the street vendors that rely on their workers, the subway system, the infrastructure that rely on all of that. That money's just not coming there. And people saying, since I'm working remote, I'm moving out of the state completely because I can move out of the state and still be within an hour and not pay the New York taxes. So I think you're going to see New York City and the state suffer significantly going forward because of that. So I think the desire to live in these big cities is becoming crazy expensive. And how they solve that problem, I don't know. So you'll have more maybe public policy recessions as well, and cities in more trouble than we thought because they were built on that. Because especially like we're in year two, we've had a significant pullback in the market in quarter three because the Fed came out and said maybe one more rate increase, and we're going to hold out longer till we start reducing them. So everybody's ratcheting down their earnings now because they're saying all these companies with a lot of debt now that we're starting to consider them high risk. So expectations are coming down. So guess what? Now the stock market looked overvalued. So now we had to go through another price correction to start moderating the prices of current stocks to what future projected earnings are.
Yeah, and like your New York example, that worst case that happens is that maybe some of your premium pricing on real estate or whatever comes down, but then they're forced to compete against other communities. And we had a shopping area around here that was charging at its height $40 a square foot. Right. Well, when they had vacancies and couldn't get people in there, that square foot kept dropping in the 20s, and then it got competitive with the other areas, which attracted new business into the areas. And now it's just a different perspective. That area is still a nice area to shop in, but it's not capable of having that premium price that it used to be able to fetch.
That's right. And I'm seeing that all over the country right now. And there's a lot of buyer fatigue right now, Joe, because post-pandemic, there was so much cash in the system. And it's an old statistic, but 56% of the pandemic money that was handed out was saved, which was significant.
That's interesting.
It's ridiculous. That's how much people did not need the money, right? When 56 didn't go to, the remaining went to debt reduction, paying bills, but 56 was actually saved. That's why we had such an inflationary scenario after all this money came out, because there was just simply too much cash in the system. And the first one was okay, and everybody said psychologically the first round was okay because it helped people feel better. They were fine, but it made them feel better.
Right.
So, and economies thrive on confidence. So that was a multi-trillion-dollar bet to keep people feeling confident. By the time we got to the last stimulus, there was plenty of money in the system already. And then people were just saying, let's just go spend it.
Yep.
Which is why we had such an accelerant to inflation. So part of that inflation, the degree of the inflation, had to do with too much government intervention in the economy.
So the last time we talked, you highlighted the fact that the amount of money that's held in student loan debt is just immense. Like the biggest, kind of like black eye in our economy was sitting right there.
Right.
How, are your feelings changed after some of these forgiveness things that have gone through? Do you have like an inflation, a little bit more afraid of inflation because of something like this? Tell me your feelings on that.
Well, you're going to see interest rates going higher. They were high enough. I think the arbitrary canceling of student loan debt, I don't get it politically. Everybody I talk to hates it, unless you have a student loan and you want it to go away.
Right.
Right? And somebody's going to wipe it off the books for you. But I think when you look at middle America and they sit there and say, it was your choice to borrow the money, it's not my choice to pay it off for you. And that choice shouldn't be rammed down my throat.
Right.
I think the easiest way to solve the problem, and it could solve rather quickly, is make them zero interest loans. Just wipe out the interest rate and take that cost of the system. That's significantly less cost to the government. And if you're paying back an interest-free loan, so many people will be debt-free really quickly. Because when you're paying a 6 or 7% interest rate, that's a big nut.
Yeah.
You
Over
know?
the course of 20 years.
Right.
Yeah.
And
So do you know who's holding the notes on student loan debt? Is it the government
Yeah.
issued or are they private lenders?
well, private lenders you can't get away from.
Okay.
You can't
They're not
wipe that
part
away.
of that, then.
They're not part of that.
Okay.
This is all government-issued loans and government-backed loans.
So the government could reduce the interest rate down to 0, and then more of their payments would go towards principal, and you'd pay it off super fast.
Why not? I mean, we all, there's irony. There's iron, and this is not a political statement. This is a business statement. There's irony by saying you chose to take on the debt, you chose to get that degree, and you chose to go to that school. And part of my complaint to that, Joe, a lot of this debt came from schools that were higher-end schools and not lower-cost schools they could have gone to. So we have to add that back. If we're going to call it out, let's call it out, right?
Right.
Okay? So you chose that debt. So you chose that career. You chose that college. Okay? I said to my kids when they went to college, you can go to college at the school that is the most cost-effective school for the degree you're trying to get. They heard this to me growing up. I don't care about your college experience. I'm not paying for your college
Right.
experience. That's for you to figure out.
Right.
You know, if you want to go to date on Friday night, you're not doing it on my debit card.
That's right.
You have to figure that out. Okay. So that's how my kids determined where they went to school. So as a result, people have this debt and they're saying, we're going to forgive this debt so that you can go buy houses, cars, and start your life. I'm like, well, if you're not paying your debt, right? And you're complaining about the debt you took on, what are you going to do with the next round of debt you get? What are we teaching people?
Right. So separate from that, so your fear from it before was that it was just hanging out there and could only bad things happen with that much debt that you didn't feel or we didn't feel that people were eventually going to be able to ever pay down. With some of that reduced, do you think enough of that reduced that that's less of a risk out there now?
I don't. I think because the debt they're getting rid of at this point are the people that are most at risk of defaulting anyhow.
Okay.
So I don't think it really helps the economy thrive. I think it was in the bank they would just consider bad loans that they'd be trying to write off anyhow.
Right.
Okay.
And you mentioned trillions when we were talking about it, and I did not see trillions worth of forgiveness. It was in the maybe 100 million is what I saw.
127 billion as of yesterday.
Okay.
Okay.
Yeah, billion.
Right.
And so that's not proportionally enough to really,
Move the needle.
yeah.
No, not when it's north of 1.5 trillion. Right.
Wow, that's crazy.
Right. Right. And honestly, I blame parents too. What are you telling your kids? Why are you letting your kids do this stuff? Because I've said this, Joe, and you've heard me say this before, and I've said this for 25 years. My problem with student debt is you're creating modern-day indentured servants.
Yeah.
Okay? Yep. Where you're paying back your college tuition for 25 or 30 years, and they're selling you on it by saying you get this college education, you're going to make so much more money, and that's how they're cost justifying the debt. Well, maybe that was true 20 years ago. But when you had a college inflation rate for years that was running double, sometimes triple our inflation rate, the cost of college just grew so exponentially, but people still held on to the same logic, right?
Yep.
And I've seen people, I've seen people, and it blows me away, would send their child away to school to be a teacher and rack up $100,000 in student loan debt. And I would say the same thing to them. What are you going to make as a teacher? Why are you spending $100,000 where no matter what school district you're going to, your starting pay is the same? Those conversations don't happen. But now that person's starting teaching, and we need teachers. It's not about teachers. It's about making a point of saying in the profession, here's your starting wage, right? And you should have been looking at that school by saying, maybe I should have found a school where instead of $100,000 in debt, I was in 40. So that when I get out and I have this job and that's my wage, I can start paying that money back and not pay it back for 25 years.
Yeah, your first 3 years, you are working for $0 because they're taking a portion of what you're working and it goes right to the university that you borrowed the money from.
That's right. Yeah, it's crazy. But we don't call that out enough by putting the responsibility back on who's suggesting the borrowing, right? Who's not calling it out why they're making those decisions. Those are the conversations we should be having now with people. And people should be having those conversations with their kids. Because I don't really blame an 18-year-old because they don't know enough about the world to make those sorts of decisions yet, right? And I also think, too, there's a lot of scholarship money because on my Sunday show, I've had the financial aid people in from YSU. There's a tremendous amount of free money that goes unused because people don't ask for it.
Yep.
They just default to the path of least resistance many cases. So,
and they make it very easy to go right from high school to get the loan, to take the classes, and to graduate, like on a lubricated slide.
Right. And sometimes to go this extra mile takes a lot of work.
Yeah.
But it's worth it. You know, at some point in time, you pay one way or the other, right,
That's
Joe?
right. Yeah, that's the theme of all these health discussions is that, number one, that it's a series of thousands of good choices versus a binary Hail Mary that either does or doesn't do. And, you know, this is just another case of that.
That's right. Mm-hmm. So it's about participating in your life.
Yep.
And that's what I say to my clients. Like when we do retirement and estate planning, I say, I want you to change how you're looking at this. You're the CEO of the rest of your life.
Yep.
Okay, so let's set that mindset, okay, and that you're in control of it. And how do you want that outcome to be? You know, so it's a much different conversation because people are very tactically driven. And sometimes when they're doing their financial plans, they know what they know, so they're in the weeds. Our job is to try to get back up and get strategic and have these kind of conversations and have them think about what the next 20 or 30 years of their life will be. Because when you're in and you're living, you feel like you're in that rat race, right?
Yeah.
You're just and the hamster wheel's going. And you're very tactical. You're making today's decisions about what are we doing for dinner tonight? What are we doing this weekend? We get in that groove. So it's very difficult for people to do personal strategic thinking, right? That's one of the things I've noticed through my career. So we spend a lot of time on that. And it's an interesting challenge for a lot of people. They don't think of it. They know it, but I said they've been conditioned to behave otherwise, right?
Yep.
So,
Leo, love these discussions. Why don't you give everybody your contact information, how they get a hold of you?
you can give us a call at 330-533-6936, or you can email me at leo@gemyoung.com. Joe, as you know, when we meet with someone for the first time, we're at that, and maybe it's because where I'm in my career, we don't sell anybody anything anymore. We ask people to buy into a way of thinking. So that's why when we meet with people for the first time, we have what we call a fit meeting, where we sit down and we talk about what their goals and their objectives are. We talk about what our philosophies are. We talk about how we get paid, exactly how we get paid, because we're a fee-based financial planning firm. We do a little personal goal planning because it's a two-way street. We want to make sure they're a fit for us as well as them thinking if we're a fit for them. We wouldn't make any decisions that day. We let everybody go home, think about it for a couple of days, then we reconvene with a phone call. And if we find that we're a fit, then we talk about the next phases of the planning process. If we're not a fit, my joke is it's a really fast phone call. So that's where we think we're really different, you know, and being a holistic financial planning firm. That's why, you know, I do a lot of this thinking. I spend a lot of time working on the strategic part of it. There's plenty of people out there wanting to handle the tactical part of it, but we think people need more than that.
All right, Leo, thank you much. Appreciate it, man.
My pleasure, Joe.